be talking about agency profitability and what that means. We have our incredible guest today. His name is Marcel Petitpas. Marcel, I'm just going to give you a quick introduction. So he is the CEO and co-founder of Parakeeto, a company dedicated to helping agencies measure and improve their profitability by streamlining their operations and reporting systems. So he's the fractional CEO or COO at Goldfront, an award-winning creative agency in San Francisco. See, you should love San Francisco. That's where it is. So working with brands like Uber, Slack, Keep, and more, as well as this head strategic coach at SaaS Academy by Dan Martell. And it's the #1 program for B2B SaaS businesses in the world. When Marcel in his work as a speaker, podcast host, consultant, specializing in agency profitability optimizations. He's helped hundreds of agencies around the world improve their profitability and cash flow in their business. So I'm excited for him to join us, and he's going to be doing exactly that. So Marcel, myself, my name is Colleen McGrath. I'm the senior manager here at Vendasta, senior manager of community. I think I even said my own title wrong. So welcome. So our our format today, the agenda, Marcel's going to start us taking us through for about 35 minutes, and then afterwards we're going to do a live Q&A. And one more thing before we get started. So we have our Conquer Local ecosystem that I encourage all participants to join. Vish is going to be sharing a link right now in the chat to have you register. And so we have an online e-learning academy. We have our podcast, which Marcel was featured on. And then we also have our community as well. So afterwards, we're going to be sending out some information about our community, and there's going to be a specific group for all of our attendees. Marcel and his team are going to jump in there too between the sessions and answer some questions. So Marcel, I'm going to kick it over to you.
All right. Thank you very much, Colleen. It's very exciting to be here and have an opportunity to, over the next 6 sessions, basically tell you everything that you need to know about how to measure and improve the profitability in your agency. I'm really interested to hear from everyone in the chat if you're watching this live. When it comes to managing the profitability of your agency, give me on a scale of 1 to 10, how comfortable you feel with that exercise. When you think about, man, I need to figure out if we're profitable, what kind of services, what kind of clients, are working well for us, when we need to hire, all the cash flow around the business. 1 to 10, how good do you feel about your ability to measure those things and answer those kinds of questions, or even forecast into the future? Most of the people that I talk to, most of the clients that we work with, do not feel very good about this and often get overwhelmed when they think about all of the different things that they could be or should be measuring in their business. And my objective for the next 6 sessions is to really boil this down to a handful of metrics that you can use to steer your agency in the right direction. Try to take a lot of the guessing work out of this and really clarify targets, clarify benchmarks, clarify calculations, really make it clear what you should measure, how you should measure it, how to assess if you're performing well or not. And then over the next couple of sessions towards the end, we'll talk about how to apply some more advanced modeling to those metrics so that we can do things like forecast into the future and to do some more forward-looking analysis on the business. And I rarely get a chance to dig into all of this stuff. I'm usually constrained to an hour or 90 minutes. And those of you that have been on a session before with me know that it can be like drinking from a fire hose because I try to cram it all in. But I have the opportunity now to, over 6 sessions, really break this down, take it a little bit slower, and work through each of these pieces and stack them on top of each other. So I hope that you'll join us live for all 6 of these, but these should be recorded and accessible afterwards. So whenever you're watching this, thank you for being here. I appreciate you paying attention to this side of your business because I believe that it's very, very important and is actually the foundation for a lot of the other aspirational things that you might be trying to get out of your agency, like a great lifestyle, like a great environment for your employees, great work for your clients, etc. Having a lack of constraints from a financial perspective makes all of those things easier to achieve. So I'm going to go ahead and share my iPad. We are going to get into the presentation for today. This is part 1 of 6, where we're going to just be talking about agency profitability 101. So a couple of simple formulas that determine the profitability of your agency and really getting an overview of some of the things that we're going to dig deeper into over the next 6 sessions. So just to summarize what Colleen talked about, I am the co-founder at a company called Parakeeto, and we help agencies run more profitably. That's what we do. It's all we do. It's all we care about. And our entire business is dedicated to serving that purpose. As Colleen mentioned, I'm also the CEO of an award-winning agency out of San Francisco, where I get to apply this stuff at a very deep level. And I'm also the host of a podcast called the Agency Profit Podcast, which you should all go subscribe to, where, you guessed it, we talk about agency profitability. I've been fortunate enough to do a lot of speaking and coaching like this in many groups that have recognized us and me as experts, and this is no different. So thank you to Vendasta for having me here. It's always a pleasure to be able to share what I know and what I'm passionate about. And again, we help agencies measure and improve their profitability. That's all we do. I don't know if I can repeat that enough, but that's literally the only thing we care about. Unlike your accountant or the other, consultancies that you might see going after this issue, this is not something we do off the side of our desk. This is the thing that we dedicate all of our thinking to. And just so everyone's clear on the kind of results that people tend to get with us, and I'm going to share with you the methodology that we use so that you can apply this on your own. Most of our long-term clients experience over 200% increases in their profitability, and on average achieve a 3 times higher profit margin than the agencies that we see coming in and that we do audits on initially. And this is generally after adjusting for founder salaries. There's lots of agencies that look like they're very profitable. And then when you look at how much the founders are paying themselves and adjust for market rates, you find out that they're actually breaking even or losing money. So after those adjustments, our agencies paying themselves a market rate salary tend to make on average 3 times more profit than normal businesses. So if this is interesting to you, if you're interested in having industry leading profitability, then pay attention over the next couple of sessions, and we're going to talk about exactly how to do that. So the first thing that I want to start with is kind of an overview of, at a high level, some of the problems that you might be experiencing that these sessions are designed to solve. So number one, when it comes to measuring the profitability of your agency or just the performance of your agency, either from an agency-wide level or zooming into things like specific clients, specific departments, specific projects or types of work, or even from a resourcing perspective, what your utilization or profitability looks like for different roles or different departments within the business. If thinking about that overwhelms you and you don't have a sense of clarity around what the strategy should be in terms of what you're going to measure, how you're going to measure it, what kind of metrics you're going to pay attention to, and you don't have a vision for how that's actually going to help you make decisions in the future, and there isn't this clarity of these are the questions that we need to answer on a regular basis in order to plan forward in our business, and these are the metrics and reports that we're going to use to measure those things, then you should have a lot more clarity at the end of these sessions on how to think through creating a system that is simple, but also aligned to the most important questions that you need answers to in your business. The second problem that you might be running into is when it comes time to run an analysis on something like, did we take as much time on this project as we thought we were going to? Did we have the profitability on this project that we thought we were going to? Are we seeing, the patterns that we want to see in our agency historically for client profitability and utilization? If trying to answer those questions leaves you messing around in spreadsheets for hours trying to clean up data, it never really seems quite that easy to get a report like this together. There's a lot of number crunching, a lot of cleanup, a lot of things that are the same but named differently across different projects or across different tools. If you're feeling like your data and your systems are kind of messy and there hasn't really been that much intention put into how they're set up and how they're configured and what things are called, then we should be covering some frameworks here that'll help you get some more clarity and, again, simplify and standardize how all of these things are set up, so there isn't so much a lack of clarity when it comes time to set up a new project in your PM or time tracking tool around what should we call things, what should we use this task object for, what should we use this list object for, how should we structure the folders that we use for client projects and deliverables, and what is a billable hour, what's not a billable hour. Those kinds of questions we should be working through so that you can clean up these systems and have some intentionality to them. And finally, if you found yourself recently guessing and stressing about important decisions in your business, like, should we discount this client project or not? Should we hire this person or not? Should we do layoffs because we just, kind of missed out on some really big RFPs or really big deals in our pipeline, and I'm not sure if we're gonna be able to keep the team busy. If you feel like you're making decisions based on gut and the really big and important decisions, and you feel like you're questioning that decision because you just don't have the data to give you confidence, then this next six session series should give you some tools to be able to bring a whole new level of objectivity to some of these questions that currently might feel existential in your business. And hopefully what that allows you to do is have some confidence when you make those decisions, so you can rest at night knowing that you made a decision that was based on reality and not based purely on gut. So if any of that's resonating with all of you, I'd love to hear in the chat which one of these three problems resonate with you. Is it number one, number two, number three, or is it all three of these? Are these all things that you find yourself experiencing? I'd love to hear from you all in the chat on that. And so my promise to you is by the end of this series of sessions, you'll have clarity on the metrics and the benchmarks that you should be paying attention to in your agency. And we're going to simplify this down to 4 key metrics and categories. The frameworks for setting up your systems and tools. So some high-level frameworks that you can use to really go and evaluate how you've set up all of your systems in your business and make sure that they are clean and aligned and maintainable. And thirdly, how to use these metrics and use the data that's coming out of your systems to start seeing into the future, because that's ultimately the goal that we all have around operations. When we really think about what agency operations is, it's about taking assumptions about people and client work and trying to project them into the future so that we can make decisions about resources and project timelines and hiring and cash flow. And so once we master the foundation of these benchmarks and metrics, and once we have a framework in place for making sure that our systems are creating clean data, then we can start to build on that foundation to project our assumptions into the future, because we'll have some stability and some accuracy in the way that we create assumptions and gather data around those assumptions. So that is the outcome that you should have at the end of these 6 sessions, is all of the clarity around the metrics, the frameworks, as well as the ability to start forecasting and looking out into the future and planning ahead, as opposed to feeling like you always have to react to what's happening in the business, which we've all felt at some point in time running a services business. So let's talk about, first and foremost, what are the 4 key metrics that you should be paying attention to in your agency. And these are the 4 key metrics that we encourage all of our clients at Parakeeto to track. And these are the first 4 things that we get tooling in place for. And most of the ongoing engagements that we do with clients where we're making their systems more elaborate are generally not adding many additional metrics to the stack. It's more so about building deeper fidelity and more precision into the measurement of these metrics. And so I want to start with the first set of metrics. And this is what we're going to cover in the next session, which is all about core financials. And the reason I want to start with core financials is because for most of you, this is something that you already have in place. You're probably already on some kind of a cadence doing bookkeeping, or you have a firm that's doing bookkeeping for you. You're getting financial reports on maybe a monthly or a quarterly basis. And so you've already got financial reporting going on. And what I want to share with you in our next session is how to get more value out of the investment you're already making in financial measurements, so that you can start to get more accurate and more helpful touch points every time that your accounting team or your bookkeeping team gets your books reconciled. Core financials will be the first set of metrics, but this is one of the misconceptions in the industry that is difficult, which is that financials and the finance department really can be accountable for measuring performance in your agency. And the reality is that financial data just isn't enough. It's slow, it's expensive, and it's often not nearly detailed enough to get you tighter and more nuanced visibility into what's actually going on in the business. We have to rely on data about people and about time to get to close that gap. And so we want to enhance core financials with non-financial metrics so that we can get visibility into what's happening on much tighter time horizons, weekly or bi-weekly touch points, and be able to, in a very inexpensive way, slice down and start to see patterns at the client or project or even service level of insight. And that can be very expensive and very difficult to do just with financials. So the 2 primary levers we're going to use to do that are measuring earning efficiency. And you'll have to excuse my handwriting. There will be a copy of these slides that are going out that have computer generated text on them. But I am a millennial and I grew up on a computer. And so my handwriting just never got that good. So this says earning efficiency. So that's the second core metric that we're going to be talking about in session 3. And then in session 4, we're going to dig into utilization. which is the most misunderstood and most dangerous metric in the agency game. It's critically important, but this is a metric that has a ton of controversy around it. And when I ask 10 agencies how do they measure utilization, I get 10 different answers. And I know many of you are listening to this thinking, that's crazy, I know how to measure utilization. There's a really good chance you're wrong, and we're going to talk about why that is in session 4 of this series. And then we're going to finish with scoping accuracy, which is really all about the science of how to scope things well, and then how to use the data that your business produces every day to make your scoping more accurate over time. So scoping accuracy will be the last one. And this is critically important because, as we mentioned earlier, agency operations is the projection of assumptions into the future. And there is no more important set of assumptions than the assumptions we make about our client work. How much time, money, effort is going to need to be inputted to deliver the things that we've promised to the client. And if those assumptions are not accurate, then it's very, very difficult to start planning into the future and doing things like capacity forecasting or cash flow forecasting. And we're also taking on a lot of risk when we can't scope things well. So this is going to be a really important part of this series, and we're going to be talking about that later on. So those are the 4 key metrics for agency profitability and the 4 things that you need to be paying attention to. I'm curious, for those of you in the chat, Renee, thank you for answering the earlier question. Which one of these 4 metrics are you most interested in learning about? You can say all 4 if you want. I'll take that enthusiasm, but I'm curious which one of these is most interesting to all of you. And with that, we're going to move in. Paula says all of them. Well, great, Paula. We're going to learn about all of them. Utilization, says Colleen. Yes, it's a fascinating metric. Utilization, says Carla. Agreed, all will be valuable. All right, well, 2 for utilization, 2 for all of them. I hope you'll all stick around for all of these sessions so that you can take it all in. Let's talk about how agencies make a profit. It's fairly simple, actually. Agencies are going to have a couple of simple numbers that, if you pay attention to them and you learn how to optimize them, really determine the amount of profit that you make. And so the formula is very simple. You have agency gross income, which we're going to shorten to AGI. This is agency gross income. And we'll spend a lot more time talking about exactly what agency gross income means, but I'll put it in simple terms. Agency gross income is the amount of revenue that your business ingests or takes in that actually belongs to the agency. And this is a really important thing to start paying attention to, because many of us have what we call pass-through costs, and it can inflate our idea of how big our business is, and it can also inflate our idea of how good our margins are. And so, for example, if I run a Facebook ads agency and I have $5 million of money passing through my business every year, but half of that money is ad spend that I have to give to Facebook. Well, I don't have a $5 million business. I have a $2.5 million business, but it's very dangerous if I'm not creating that separation, because I don't want to make decisions on spending, and I don't want to be measuring my margins based on that $5 million number. I really want to be doing it based on that $2.5 million number. So agency gross income is the first thing to pay attention to. So once we strip out all of our pass-through, we have kind of the true revenue of the business. And in this example, we're going to say we have a business that's doing $1 million in AGI per year. I'm going to shorten that to 1 million just because it's easier. And then the first and most expensive part of earning revenue in an agency is our delivery costs, right? So this is the business model that we are all in. We sell time, and there are lots of different ways that we try to abstract away from that in our pricing and how we talk about ourselves and how we package our services, but all of us are in the same business. We sell time at a margin, and we deploy that skilled time against getting things done that ideally have a much higher value than the cost of the time. And that leaves us with some kind of a margin. And so generally, our delivery costs are going to make up anywhere from 30 to 65% of our costs relative to AGI. And generally, the benchmark here is we're trying to spend roughly 40% of our AGI on delivery costs. So in this example, this company has spent $400,000 on delivery costs. Most of that is going to be the payroll associated to the team of people that we need to deploy against this client work, the designers, developers, copywriters, project managers, et cetera, or the freelancers that we're bringing in and hiring to do this work. And that's going to be the most substantial cost of doing business generally for an agency. And then once we have pulled out our delivery costs, then we need to factor in our overhead, right? So there's a cost to running the business. We need lawyers, we need accountants. Sometimes we need an office. Sometimes we need a beanbag chair and kombucha taps because we want to be cool and give our team a cool working environment. At Vendasta, I'm sure that there's a beer keg somewhere in the office. That's the kind of vibe I'm getting. I don't know that to be a fact, but I'm just making an assumption. It feels pretty safe. Colleen's nodding her head. Yeah, saw that one coming. So, and that's an endearing thing, by the way. You're all very chill. I'm not calling you a bunch of drunkards. Okay, so in this case, we generally want to spend anywhere from 20 to 30% of our AGI on overhead. And ideally, what that leaves us with is a profit margin. And in this example, this agency has spent 40% of their AGI on delivery, which is healthy, leaves them with a 60% margin on every dollar that they earn. And then they spend another 30% of their AGI on overhead. And this leaves them with a $300,000 profit, which is equivalent to 30% of AGI as profit, which is really good. It's very healthy. Most agencies are sub 10%. So anything south of 25% in my mind is really good. So this is the formula for how we make a profit as an agency. And so the two levers that we can pull in order to improve our profit margin are, of course, decreasing the amount of overhead that we have relative to AGI. And this is the first place that people tend to go when they're having profitability problems, is they start going into their P&L and trying to cut software expenses, trying to save some money on bookkeeping, trying to get rid of, unnecessary expenditures. And all of that is fine, but generally is not the biggest lever that needs to be pulled. Generally, the biggest lever is improving the ratio of delivery costs to agency gross income and ultimately improving our delivery margin, the amount of money that it costs us to earn $1 of revenue. And so we're going to spend most of our time focused on this number right here, delivery costs, and how to improve the ratio of delivery costs to agency gross income. How do we make sure that every dollar that we spend on delivery labor is able to return more agency gross income? How do we make sure that the team that we're hiring to do work, they're spending most of their time doing things that earns the business revenue, and we set them up so that every hour that they spend doing work for clients is very efficient. They can get a lot of things done, therefore earning a lot of money with every hour that they work. When we pull those two levers, that's how we improve that ratio. And that is what really sets the foundation for the profitability of our agency. And to illustrate this, I want to take you through an example. I'm going to use some metrics here in the next slide that we're going to spend a lot more time in the next couple of sessions digging into. So I'm just going to cover them at a high level, but just know that we are going to dig into this in more detail in the follow-on sessions. So this is the formula of really how our agency gross income is determined relative to our delivery cost. It starts with capacity. So all of us have a given amount of capacity on our team at any given moment of time. We are deploying money against payroll, and that payroll is buying bulk amounts of people's time. So as an example, if I hire a full-time designer, I'm generally buying 2,080 hours of that person's year. I'm pre-negotiating, I'm going to pay you this salary. It's $100,000 per year. And in return, I want 2,080 hours of your life. That's the deal that we make when we sign an employment agreement. And the idea there is I'm going to resell a portion of those 2,080 hours for a profit. That benefits us both. You get to have a job with some certainty and a regular paycheck. I get to make a profit. Part of that is going to go back into making sure you have a great work environment. And that's a mutually beneficial deal. That's what we call commerce. So in this example, this agency has 10,000 hours of capacity in a given time period when they look at the whole team that they've hired and all the hours that they've bought in bulk. The next thing is utilization. So the question here with utilization is, how many of those hours that we purchased are being deployed against things that earn us revenue, essentially getting work done for clients? And there's a really simple way to think about this. This is where it starts to get complicated with utilization. Well, vacation time and paid time off and delivery hours versus non-delivery hours. And how do we, let's make that really simple for now and just really look at this in terms of everybody on the team, no matter what their job title is, if they're in sales, admin, if they're delivery, we're going to count everyone's capacity, and we're not going to strip anything out. Not going to strip out vacation time, holidays, paid time off, any of that. We're just looking at all the time that we've purchased. And then we're looking at how much of that time actually gets used against client work. So in this example, we're going to say that there's 50% utilization at the end of this time period. 50% of the time that we've bought is actually getting used to earn us revenue. Then the next question is, okay, well, how efficiently do we earn that revenue? And we use average billable rate to measure that as a simple metric. So average billable rate. And in this example, this agency is currently doing an average billable rate of $100 per hour. So every hour that their team works, on average, they get $100 worth of work done for clients. And it doesn't matter if they're billing by the hour or they're billing flat rates. This metric works, and we'll learn about why when we get into the calculation in one of the next sessions, but this metric works no matter how you bill. This is really just the measure of, at the end of the day, for every hour that your team had to work for client stuff, how much revenue came into the business. So in this example, if we have a 50% utilization on 10,000 hours of capacity, that's 5,000 hours of billable time. And each one of those hours earns $100. And so this agency in a given period of time can earn $500,000 with their available capacity. Now let's go with second scenario. We have the same capacity, the same utilization, but now we're going to make an improvement to our average billable rate. We find a way to get the same type of work done in fewer hours, which increases our average billable rate now to $125 per hour. Maybe we also charge a little bit more for certain things. Now the same team, because we've made a small improvement to average billable rate, with the same payroll, same cost structure, same overhead, can earn $625,000 in AGI in that same time period. So if you really think about it, that's all pure profit. There's $125,000 in additional profit that's now available to this team because nothing has changed about the cost structure of the business. Only the efficiency of this team has changed by increasing the amount of money per hour that this team is able to earn through process or pricing, whatever the levers are that we want to pull there. And in the last example, we'll increase utilization. So we go from 50% to 55%, which only represents 500 hours over the course of this time period, which is not much relative to the total. We're going to maintain our $125 average billable rate. And now the same team can earn $687,000 in that same time period. So $187,000 in additional profit just by pulling these two levers, utilization and average billable rate. We've increased the efficiency of the capacity that we're deploying our payroll against, thereby increasing the amount of profit that's available from this team, because nothing has changed about the costs here. We haven't hired anyone. We haven't invested any additional money into overhead. We can choose to do that. But ultimately, the lever that we've pulled, coming back to this equation, is improving the ratio of AGI to delivery cost by making it more efficient. So we're going to spend a lot of time digging into the details and the nuances and the formulas and the benchmarks behind these metrics here: utilization, average billable rate. We'll also talk about financials. There's so much more for us to talk about, but I'm going to keep it high level for the first session, just to give you a taste of how simple this can really be when we understand these fundamental building blocks and how big of an impact these small tweaks to these simple metrics can have on the profitability of your business. The last thing that I want to touch on is how this all comes together to really help us with estimation. And what we're going to talk about towards the end of this is how to build really cool models that essentially are an algorithm for how our agency scopes work. And so let me just get my big fat face out of the way here. There we go. So this is the estimation matrix, and this is how my brain works when I think about estimation. And we're going to talk about how to put all the data points together and how to create the data in your agency to measure this kind of stuff. But if you can imagine, I sell websites. And the question that I want to know is, for every dollar of budget that the client has for a website, how much additional project management time do I need to budget for a website build? So let's just imagine that that's the question that I need to ask, right? So website PM time. If I have created a standardized structure to my estimates, to my time tracking data, and I've collected this over time, what I can start to do is essentially create this graph. So on one axis, we have the amount of effort that's required. to do this kind of work. Usually that's measured in terms of hours. And another axis, we have the complexity of the project. And in this case, we're just going to use the budget as the complexity. And so if I'm collecting in a standardized way the amount of project management hours that have been used and the budget for every website project I've done over the last 6 months, now I have these data points. These are all projects that can show up on this graph. So this project, as an example, let's just say that it falls here on the line. So this was a $40,000 website, and it took, let's call it 75 hours of project management time, right? So all of these data points are going to have some relationship of budget to effort. And the more I put on here, the more I start to see this relationship line emerge, which essentially helps us understand, on average, for every dollar you add to a website budget, this is how much additional project management time you need to plan for. And so we're going to talk about creating the data on this graph so that we can develop this kind of algorithm for ourselves. And then we'll talk about using process to start to squeeze the distribution of those data points closer and closer to the center, because the more well-defined the way we do things becomes, the less splay we're going to have in the data, the less variation we're going to have in how much time it takes to do things, because we'll have more and more deliberate process, more and more deliberate rails. And these two functions, adding more and more data to this graph, as well as increasing the amount of standardization to how these data points are spread out over this graph, is what allows us over time to create these models, these relationship lines that allow us to estimate things very accurately and extremely quickly, and really start to build our own algorithm for how long it takes us to do things in our business, as well as identify the areas where we are best suited to making investments in process and investments in pricing improvements, and really where we should be paying attention. So this is some really advanced stuff that we're going to touch on later on in the session, but I wanted to seed this again just to create some excitement about what's to come. So on the next session, we're going to be talking about core financials, and really what is it that you need to be getting out of your financial reports every single month or every single quarter, whatever that cadence is for you, and how to really get more value out of what you're already paying a bookkeeper or accounting team for. That's what we're going to dig into on the next session and really go full out on. So make sure you tune in for that next session. It's coming up next Tuesday. And with that, I want to remind everyone as well to fill out the feedback survey that is going to be shared with you after this session. We always like to get your feedback so we can make improvements to the way that this thing runs and make sure that your top concerns get addressed. So there's going to be a link shared with all of you. Vish and Colleen, you have the details on that. I was just told to make sure everybody knows about the survey. So you all know about the survey now. I've done my piece. And with that, we are going to go into Q&A. And I just want to encourage everyone to head to parakeeto.com and grab this free toolkit that I put together for all of you that has a bunch of free resources and templates that you're going to be able to use as we go through this training to actually apply what you're learning in real time. So if you want access to those free tools, go ahead and grab them there. And now we're going to open things up for some initial Q&A here after session 1. So I'll turn it back over to Colleen to moderate that.
Woohoo! Awesome. Thank you so much, Marcel. So we do have the Q&A feature if you can jump in there and drop your questions, but I see there's one in the chat. Brandon asks, where does owner contribution, distribution / pay come into play in that equation?
All right. Owner comp. That is a great question, Brandon. So thank you for asking that. Let's talk about owner compensation. So coming back up to the equation here. Sorry, here we go. All right. So we've got a couple of numbers here. We have delivery costs and we have overhead. So the first thing is you should have your market rate salary built into this, and your salary is likely going to be distributed across overhead and delivery. So depending on what scale your agency is at, let's say you're a small team, there's maybe 6 of you on the team right now, you're probably still spending a decent amount of your time actually doing stuff for clients because you're likely still going to be one of the highest skill execution type people on the team. And so maybe you've got 30, 40, 50% of your salary allocated to delivery. And then you probably have the other remaining percentage distributed to administration or sales and marketing. And that's going to be covered in overhead. And then profit is, the way we like to measure this is like before, usually we look at this in terms of EBITDA. So earnings before taxes, interest, amortization, et cetera, and before distributions to owners. If you're having to do dividends and distributions to get yourself to a market rate compensation, then one of two things is true. Number one, your salary isn't high enough, or number two, you're just trying to be tax efficient, which I totally get and I have nothing against. Like if you want to pay yourself, the minimum possible salary and then pay yourself in dividends because the tax rate's just a lot better on that, that's cool. But you're not actually as profitable as what it looks like when you're counting all of those things in your profit margin. So your profit should be indicative of what's left over after you've actually paid yourself a market salary, Brandon. So that's how these things are factored in here. I hope that answers your question, but if it doesn't, feel free to let us know in the chat or come on live and we can dig in a little bit further. But hopefully that gives you some clarity. The other question I get around this is, what is market rate for this kind of thing? And also, why is this important? And first of all, I'll tell you why it's important. A lot of people have this idea that, well, I want to sell the business, so I'm going to pay myself a very tiny salary, and then it's going to look like we're really profitable. And then my multiple when I sell is going to be higher, right? And this is based on the assumption that most agencies, when they sell, the amount of money that they can sell the business for is usually a multiple of profit. So as an example, if we had 100,000, right, let's just do a simple example. If we have 100K in profit, and we're selling for a 3 to 5x multiple, then the business is worth anywhere from 300 to 500K. But if I'm a tricky founder and I say, well, instead of paying myself $130,000 a year, I'm going to pay myself $30,000 a year. So now it looks like my profit is 200K, which means at a 3 to 5x multiple, now my business is worth between 600 and $1 million. Look at that. I just made all this money with a little bit of financial trickery. But here's the deal. Unless you are being acquired by the dumbest acquirer of all time, they're going to just make this adjustment. They're going to look at your P&L. They're going to look at your payroll because that's all part of due diligence. And they're going to go, oh, here's the CEO of, in this case, probably at least a $500,000 a year agency that's paying themselves $30,000 a year. I could not hire somebody to run this business for $30,000 a year. And so I need to adjust this to at least $100,000 in order for this profit margin to be reflective of the actual performance of the business. And so this kind of financial trickery doesn't really actually work in the case of an acquisition. And so if you are going to do this kind of thing, it should just be for the purpose of tax efficiency, and understand that your profit margin will be adjusted in an acquisition scenario to reflect market rate salary, which is usually at least $100,000. And really, most of you that are running an agency could probably go out to market and make this or a lot more, given your skill level. You probably wouldn't be running your own agency if you weren't really good at what you did. And so this is kind of the baseline, is at least 100K in owner comp. And however you are figuring out how to pay yourself, whether you're doing stuff for tax efficiency or not, you should be adjusting your profit margin to reflect you making at least this much money. And if you can't pay yourself this much money and still make a profit in the business, then the business is fundamentally not profitable yet. And if it's your first few years, that's totally fine. It's not uncommon, especially if you have a small team. But just know that this idea of moving your comp around as an owner to try and affect your profit margin, it's not really a real thing. So hopefully that gives you a very detailed answer, Brandon. I see you have some additional notes here. My partner and I are some of the highest value members of the team. We're growing and maturing. Last 8 to 12 months have brought on PMs, which is complicating the business. Currently, my partner and I are paying ourselves distributions based on hourly pay. Super helpful. Awesome. Thank you, Brandon. I'm glad that was helpful. Let's move on to the next question.
Okay, so we have, how can agencies manage delivery and overhead costs in the current environment we're in, where inflation is driving input and labor costs much higher? Is the solution to simply increase ABR?
Yes, good question. Let's talk about that. So eroding margins. We're going to get into so many more of the mechanics here, but let's talk about that for a moment. So increasing ABR, that's an interesting question, right? So the assumption there is just charging more money is how we increase average billable rate. But actually there's another lever that we can pull, which is decreasing the cost of earning a dollar of revenue, or decreasing the amount of time that we need to invest. And there's this other one that isn't really captured in average billable rate, but is captured in delivery margin, which is a more detailed way of measuring earning efficiency, which is spending less money to earn that same dollar of revenue. So I want to talk about a couple of different concepts here. The first is around overhead spending. And of course, one of the easiest ways to decrease your overhead spending is to move to a more remote team. You can generally cut anywhere from 4 to 6% of your overhead by just not having an office. So just keep that in mind. Most companies that do have an office spend anywhere from 4 to 6% of their AGI on that office space. And so you can basically return 4 to 6% of your AGI to your bottom line just by not having an office, and maybe retaining like 1% of that budget for home office stipends, buying your team monitors and standing desks and all that kind of stuff. So they've got a great homework setup, but you don't have to pay rent. You don't have to pay utilities. You don't have to do a $12,000 a year lease on a copier that nobody ever uses. I mean, like that stuff is kind of getting antiquated, and you'll probably be more competitive in the race for talent, because, I don't know if your news feed on Instagram looks anything like mine, every second meme that I see is about employers trying to ask their team to return to the office and then being like, I'm going to quit. So that doesn't have to be you. So that's one kind of trick around overhead, is moving to a more remote environment or looking for ways to cut your office spending is an easy way to do that. The other primary lever is earning efficiency. So let's talk about the three levers. Three levers for delivery margin. So the first one, of course, is increasing price. And most people could increase their prices. That's an easy first thing to do, but it's not the whole solution. And a lot of people will kind of lead you to believe that there's just no limits to this, and your mindset is the only barrier to increasing your price. I wish that was true, but and I don't typically like economics as a discipline. I think it's a little reductionist. However, there is some legitimacy to supply and demand as it relates to price. If you're selling to small businesses, they just don't have infinite amounts of money. And so there are going to be some considerations around price that have some amount of blocking to just how much you can charge. So you generally, especially over time, you can't absorb all of the erosion of margins just with increasing your price, but that is the first and easiest thing that you can start to do, right? So one is increase price. How do you know if your price is high enough? Well, the benchmark here is that you want to aim for about a 70% delivery margin on your scopes of work. We're going to go much deeper into what exactly that means when we get into our scoping session here that we're going to do together, but you want 70% delivery margin or more when you scope out a project. That's generally what you're trying to achieve. That should allow you to land somewhere around 60% on your profit and loss statement and be very profitable. Now, if you can't get all the way there with the price increase, what's the second thing? You want to increase efficiency. And really what that means is decrease hours. Decrease hours. Right. And so recently we've done this, and I can talk about this because we're a service company ourselves. We are an agency for agencies. It's a little bit meta, but we get to eat our own dog food, which is fun. So we had a product. We still have this product. It's called an agency audit. It's the first thing we do with our clients. It used to cost $5,000 many moons ago. Now it costs $7,000. And the amount of time that it takes us to do this service is half of what it was when we charged $5,000 for it. So our margins are substantially better on this product, but not all of that upside came from the price increase. There was a little bit of an upside from the price increase, but the majority of the upside that we have achieved on this has come from us building tooling and processes to start reducing the amount of time that it takes us to do this thing. And so generally, what we're aiming for here is, if we think about average billable rate, we want our ABR to be 3x our average cost per hour, right? Which should get you to about a 70% margin. So we're going to talk about the formula for ABR. We'll go into much more detail on that later, but that's the second lever that you can pull. The third lever is drop your cost per hour, right? So this is another thing that we've done at Parakeeto. It now takes us half as much time as it used to do an audit. But the second thing that's very interesting is I used to be, as the lead consultant, the person that was doing all of the work on the audit. Now, 2/3 of the work is done by people on my team that cost a fraction of what I cost as a resource, because I am an extremely high value person. In order to replace myself on the team, it's a fairly high salary band. We're talking about $150K a year to hire somebody at the experience level that's required to replace me. Whereas I can have data analysts and account managers that cost half of that or less doing the majority of this work, because we've built great processes around this. So now the actual cost of the time going into this is lower as well. That's another way to increase that margin and help fight the eroding margins that we're seeing in the market due to salaries going up and all these other things. And so there's a framework around this that I want to share, which is this kind of a relationship between, as our documentation gets better, the amount of judgment required to do that work goes down. And generally, when we are paying senior people more money, it's because they have better judgment. They have better judgment because they have more experience. They're able to make decisions with less information because they generally just have a higher level of judgment. And so the way to combat that and allow ourselves to give that same work to somebody with less experience, and generally therefore that are costing us less money, is to increase the fidelity of our documentation and make it more clear, more standardized, more repeatable, so that we don't need to rely on high judgment individuals to be making the majority of the decisions on a project. And so most of you have a decent amount of the work in a client engagement that is fairly repeatable, and a little bit of documentation can go a long way in allowing you to drop your cost per hour and find lower cost resources to do the work. Geo arbitrage is an opportunity that is eroding, but it still exists. It is still possible to hire people that are highly skilled in other ecosystems, in other countries, that cost substantially less than onshore resources. But the way that we need to be able to do that is by having really good documentation, really good process, so that that distance, language barriers, time zone challenges, those things don't end up being problematic, or as problematic as they otherwise would be if we didn't have clear documentation on how to do things on our project. So those are the 3 levers to essentially protect our margins. And again, we're going to go much deeper into all these mechanics throughout these 6 sessions, but hopefully that gives you a starting point. Great question.
Thanks, Marcel. Okay, we have run out of time. So many great questions. I got one in the Q&A. And so is it Adela? I'm so sorry if I'm pronouncing your name wrong. We'll add it to the community group. So I had shared a link just in the chat here of where you can find our community group. Join it. You can ask more questions. Marcel and his team will be inside and answer your questions along the way. Are the subsequent webinar invites going to be sent out? That is a great question, and I think someone on the team can answer that. Yes. Yes, yes, yes. What software, what presentation software do you use? Do you have a quick answer?
Notability. This is Notability on the iPad. And by the way, Jim average, or I shouldn't say average, but the minimum market rate compensation for modeling purposes is at least $100,000. Average is going to be geo and industry dependent. So you'll want to do your own research on that. But if you're not paying yourself at least 100K, then you're probably going to get adjusted in an acquisition scenario.
Great. Thank you, everyone. I shared the community group one last time. Thank you so much, Marcel, for joining us in a great presentation. We will see you all next week. Have a great rest of your day.
See you next
Thank
week.
you.
Bye, everyone.